if you're 65 or older, there's genuinely good news this July. And it has nothing to do with a check in the mail. It has to do with 3 tax changes that are already reducing what you owe, whether you've noticed yet or not. Stay with me for the next few minutes. This isn't a rumor or a secret loophole. These come straight from the IRS and from federal tax law that's already in effect for this year. We're not talking about a one-time deposit. We're talking about thousands of dollars in reduced taxable income every year through at least 2028. And July matters here for a specific reason. It's exactly the halfway point where you can still act on one of these before the year closes. There are 3 of these changes. 3. And most people haven't caught even one, not because they don't qualify, but because these are new, they're spread across different tax forms, and most software just applies them quietly in the background without ever explaining them to you. Here's the biggest misunderstanding I see. Turning 65 didn't just make you eligible for Medicare. It quietly opened the door to a stack of deductions most people think of as one senior thing. It's actually 3 separate pieces. They interact with each other, and mid-year, right now, is the right time to check whether all 3 are working for you. Here's why July specifically is a good moment for this. Tax season is behind you, so if you already filed, you can go back and check exactly what was claimed on your return. You're not guessing, the paperwork is sitting right there. And if you're planning ahead for the rest of this year, especially the 3rd change we'll cover, July gives you enough runway to act before December 31st, instead of scrambling in the last week of the year when custodians and charities are slammed with requests. This isn't just for people living only on Social Security. It applies to people still working part-time, people with pensions, people taking IRA withdrawals, and people who itemize their deductions. If you're 65 or older, at least one of these 3 almost certainly applies to you. If you're 70 and a half or older with a traditional IRA, all 3 can apply at once. Let's go through all 3, one at a time, and I'll walk through real numbers so you can see exactly what this looks like on paper. The first one is new. It's called the Enhanced Deduction for Seniors, and it comes from a tax law passed in 2025, sometimes referred to by its nickname in the media, the One Big, Beautiful Bill. You don't need to remember that name. What matters is what it does. In plain terms, if you're 65 or older, you can deduct an extra $6,000 from your taxable income. If you're married and both you and your spouse are 65 or older, that's $12,000 off your combined taxable income. $6,000 off your combined taxable income. Not a credit with complicated qualifying math. A straightforward deduction that lowers the income the IRS taxes you on. To be clear about the difference, a deduction doesn't hand you $6,000 in cash. It reduces the income you're taxed on by $6,000. So the actual dollar savings depends on your tax bracket. If you're in the 12% bracket, that $6,000 deduction is worth about $720 in reduced taxes. If you're in the 22% bracket, it's worth about $1,320. For a married couple both claiming the full $12,000 in the 12% bracket, that's roughly $1,440 in reduced taxes, just from this one piece. Here's what makes it easy to miss. It doesn't replace anything you already had. It sits on top of your existing standard deduction. You don't need to itemize to get it. You don't give up anything else to claim it. It's what's called an above-the-line deduction in some contexts. But the simplest way to think about it is this: it's extra, not instead of. Now let's talk about who qualifies and how the phase-out actually works, because this is the part most videos skip over, and it's exactly where people get confused. To qualify, you need to have turned 65 by the last day of the tax year. If you were born on January 1st, the IRS actually treats you as having turned 65 the day before, so you'd qualify even if your birthday technically falls right at year-end. That's a small detail, but it trips people up. The deduction phases out gradually as your income rises. It doesn't just disappear all at once at a certain number. For a single filer, the phase-out starts at $75,000 in modified adjusted gross income. For every dollar of income above that threshold, the deduction shrinks. By the time your income reaches $175,000, the deduction is fully phased out to zero. For a married couple filing jointly, the phase-out starts at $150,000 and reaches zero at $250,000. Here's a real example to make this concrete. Say you're single. 68 years old and your modified adjusted gross income is $95,000 for the year. That's $20,000 above the $75,000 threshold. The deduction reduces gradually as your income rises above that point, so instead of the full $6,000, you'd receive a partial deduction. Smaller than the maximum, but still meaningful. If your income were $60,000 instead, well under the threshold, you get the entire $6,000, no reduction at all. Here's where it gets even more important. This deduction is scheduled to run through tax year 2028. That's 4 filing seasons in total. If you already filed your 2025 return earlier this year and you're not sure this was applied, July is a good time to check. And if it turns out it wasn't applied and you were eligible, you may be able to file an amended return to claim it retroactively. The action step on your tax return, this appears on Schedule 1A in the section labeled Additional Deductions. If you already filed and want to confirm it was applied, ask your preparer directly. Was the new $6,000 senior deduction on Schedule 1A applied to my return? And if my income is near the threshold, was the phase-out calculated correctly? If you haven't filed yet, or you're adjusting your withholding for the rest of the year, make sure your birth date is entered correctly in whatever software you use. Here's where the confusion happens for a lot of people, and it's worth slowing down on because I see this mistake constantly. There's a separate, older additional deduction for people 65 and older that's existed for years, well before the new $6,000 deduction we just covered. This one isn't from the 2025 law, it's been part of the tax code for decades, and it adjusts slightly for inflation most years. People often assume the new deduction and this older one are the same thing, or that the new law simply replaced this one. Neither is true. They stack, meaning you get both, added together, assuming you qualify for both. For 2026, this older additional deduction is worth $2,050 if you're a single filer, or $1,650 per qualifying spouse if you're married filing jointly. This same deduction also exists for people who are legally blind, regardless of age, but we're focusing on the age-based version here. So it's not just the new $6,000 deduction that applies if you're 65 or older. This separate older deduction applies too, sitting right alongside it. Let's put real numbers on the full stack using a single filer as the example. Start with the regular 2026 standard deduction, which is $16,100 for a single filer. Add the older age 65 additional deduction of $2,050. Add the new $6,000 senior bonus deduction. That's $16,100 plus 2,005 towers plus $6,000, which comes out to $24,150 in total deductions before you've itemized a single thing. For a married couple where both spouses are 65 or older, start with the 2026 married filing jointly standard deduction of $32,026 married dollars. Add 1,650 T per spouse for the older age-based deduction. That's $3,300 combined. Add the new $12,000 senior bonus deduction, assuming both spouses qualify. That's $32,200 plus $30,000, which totals $47,500, which totals $47,500 in combined deductions. $47,500 of income that simply isn't taxed before you've done any additional tax planning at all. That's the real size of the stack, and it's exactly why understanding all three pieces, not just the one getting the headlines, matters. This matters because when people hear about the new senior deduction, some assume that's the whole benefit and stop paying attention. It's one piece, a big piece, but one piece of a bigger stack. The action step, when reviewing your return, ask to see the actual standard deduction worksheet, not just the final bottom line number. You're looking for evidence of two separate age-related add-ons, not one combined figure that hides how it was built. If your preparer or software only shows you a single number, ask them to break it into its parts so you can confirm both pieces were applied. The older deduction and the new one. The third change applies if you're 70 and a half or older with money in a traditional IRA, whether or not you're currently required to withdraw from it. There's a long-standing rule letting you transfer money directly from your IRA to a qualified charity without that money ever counting as your taxable income. It's called a qualified charitable distribution, or QCD, and some people call it an IRA charitable rollover. It's not new, it's been around since 2006, but two things about it changed that make it worth planning around this July specifically. First, the amount you're allowed to transfer this way went up. For 2026, the limit is $111,000 per person, up from $108,000 in 2025, because the limit adjusts for inflation each year. If you're married and you both have your own IRAs, that's potentially $222,000 combined between the two of you, since each spouse has their own separate limit tied to their own IRA. Second, and this is the part fewer people know, recent tax law changes made regular itemized charitable deductions less generous starting in 2026. If you give to charity by writing a check or donating from a regular bank account, and you itemize your deductions, new rules mean only the portion of your giving above a small percentage of your income is actually deductible. And there's now also a cap on the maximum tax benefit high-income filers can receive from any itemized deduction. A QCD sidesteps both of those limitations completely because the money is never counted as your income to begin with. There's nothing to deduct because it was never taxed in the first place. Let's walk through why that matters with real numbers. Say you're 75 single and your required minimum distribution from your IRA this year is $50,000. If you take that full $50,000 as regular income and then separately write a $20,000 check to a charity you support, your $20,000 gift is now subject to the new limitations on itemized charitable deductions, meaning you likely won't get to deduct the full amount, and your $50,000 RMD is fully counted as taxable income either way. Compare that to directing $20,000 of that same required distribution straight from your IRA to the charity as a QCD instead. That $20,000 never counts as income at all. Your taxable income from the distribution drops to $30,000 instead of $50,000, and the charity still receives the same $20,000. You've satisfied part of your required withdrawal, supported the same cause, and lowered your taxable income more effectively than the check-writing approach would have. There's one more piece worth knowing, because it's easy to miss and it connects back to your day-to-day cost of living. Your Medicare premiums are calculated based on your income from 2 years prior through a rule called IRMA. If your income is unusually high in a given year, say because of a large RMD, it can push your Medicare Part B and Part D premiums higher 2 years later. Because a QCD keeps that money out of your taxable income and out of your adjusted gross income entirely, using a QCD instead of taking the full distribution as cash can help keep your income under those Medicare premium thresholds, which can mean lower Medicare costs down the road, not just a lower tax bill this year. Here's why July matters for this one, specifically. The deadline to have a QCD count for the current year is December 31st with no extensions. If you're required to take a minimum distribution from your IRA each year, a QCD can satisfy that requirement, meaning it's not an extra step on top of what you already have to do. It can replace money you were going to withdraw and pay tax on anyway. Doing this in the summer rather than the last week of December gives your IRA custodian plenty of time to process the transfer correctly, gives the charity time to properly receive and acknowledge it before year end, and gives you time to plan the exact amount around your actual required distribution for the year instead of guessing under a deadline in a rush. The action step. This only works if the money moves directly from your IRA custodian to the charity, never into your own bank account first. Even briefly, even for a day. If the money touches your personal account at any point, it no longer qualifies. Call your IRA custodian now, tell them specifically that you want to set up a qualified charitable distribution, and give them the charity's information so they can send the transfer directly. Doing this in July instead of December means you're not racing the calendar and you give yourself room to confirm everything was done correctly before your 1099-R shows up early next year. Let's bring this together. 3 real changes in effect right now if you're 65 or older, or 70 and a half for the third one. Number 1, a new $6,000 deduction, $12,000 if married and both spouses qualify, available through 2028, claimed on Schedule 1A, phasing out gradually between $75,000 and $175,000 and income for single filers, and between $150,000 and income for single filers, and between $150,000 and $150,000 to $150,000. Number 2, a separate older additional standard deduction for people 65 and older, $2,050 single, $1,650 per spouse for 2026 that stacks on top of the new one, bringing a single filer's total deductions as high as roughly $24,150 and a married couple's as high as roughly $40,500 before any other tax planning. Number 3, if you're 70 and a half or older with an IRA, the qualified charitable distribution limit is now $111,000 for 2026. It's more valuable than before because of new limits on regular charitable deductions. It can help manage future Medicare premiums by keeping your income lower, and July is the ideal time to set it up before the December 31st deadline. None of this requires anything complicated from you. It requires asking the right questions with the right numbers in hand at the right time of year. Here's what to do next. Go to irs.gov and search Enhanced Deduction for Seniors. That page confirms everything I just told you about the $6,000 deduction straight from the source, including the exact phase-out thresholds. If you have an IRA and you're 70 and a half or older, call your IRA custodian this month and ask about setting up a qualified charitable distribution. Don't wait for December. And if you work with a tax preparer, don't just ask, did I get my senior deductions? Ask specifically, did I get the new $6,000 deduction on Schedule 1A? Was the phase-out calculated correctly if my income is near the threshold? And did I also get the separate, older additional standard deduction for being 65 or older? 3 specific questions, 3 specific answers you should hear back clearly. These numbers change every year, and updates like this one don't come with a letter in your mailbox explaining them. I cover every change like this as soon as it's confirmed, so if this was useful, staying subscribed means you won't have to go looking for the next one yourself. I'll bring it to you.